In this chapter, we will explore using securities markets, for example, the stock market, for financing and investing opportunities. To demonstrate how important the information in this chapter is, I want to share an example with you. If someone had bought 100 shares in McDonald's when it was first available to the public in 1965, it would have cost them $2,250. If they held on to the stock, the number of shares they'd have today would be 74,360 after 12 stock splits, with a value of approximately $7.4 million. Let's talk more now about how this can occur. Securities markets are financial marketplaces for stocks and bonds, and they serve two main functions. The first is that they assist businesses in finding long-term funding to finance capital needs. An example of this is that a company can issue stock to raise more funds for the organization. This is an example of equity financing. The second reason is so that people like you and I can invest in the stock market. Private investors use the stock market to invest in items such as their retirement accounts, which we will discuss more later. Organizations that facilitate the buying and selling of stock are known as stock exchanges. Some of these are actual physical facilities, whereas others are primarily computer networks. The most famous of the physical variety is the New York Stock Exchange. This is located just off Wall Street in New York City, leading to the frequent use of Wall Street as a metaphor for either the stock market or the larger community of financial companies in the immediate area. Security markets can be divided into primary markets, which handle the initial public offerings of stocks and bonds, and secondary markets, which handle all of the public buying and selling after that. The secondary market would be the market that most of us would buy our stocks and mutual funds through. Companies with solid growth potential may also seek funding from the public at large, although only a small fraction of the companies in the United States are publicly traded. Whenever a corporation offers its shares of ownership to the public for the first time, the company is said to be going public. The shares offered for sale at this point are the company's initial public offering, or more commonly known as an IPO. Going public is an effective method of raising needed capital, but it can also be an expensive and time-consuming process with no guarantee of raising the amount of money needed. Just to give you an example, Facebook's 2012 IPO raised $16 billion for the company. Stocks refer to ownership or equity in a company, and a share of stock represents a specific portion of ownership. Stocks are part of a class of investments known as securities, along with bonds, mutual funds, and several others. A dividend is a distribution of earning to the shareholders of a corporation, and these can be paid as cash or as additional shares of the stock. Some advantages of issuing stock for a company include that shareholders are owners of a firm and never have to be repaid their investment. There is also no legal obligation to pay dividends, and issuing stock can improve a firm's balance sheet since stock creates no additional debt. However, there are disadvantages as well, which include stockholders have the right to vote for a company's board of directors, which we talked about in an earlier chapter. Issuing new shares of stock can also alter the control of the firm because of this. Dividends are also paid from after-tax profits, and they are not tax deductible like interest from issuing bonds are. And finally, the need to keep stockholders happy can affect decisions made by management of a company. There are two classes of stock that exist. The first is common stock. This is the most basic form, and the holders of this type of stock have the right to vote for the board of directors and share in the profits if dividends are approved. Preferred stock are owners that are given preference in the payment of company dividends before common stock dividends are distributed. In the event of bankruptcy, the rights of common stockholders are subordinate to preferred stockholders. Preferred stock can also be three different types: callable, convertible, and cumulative. Callable preferred stock is a type of preferred stock in which the issuer has the right to call in or redeem the stock at a preset price after a defined date. As with regular preferred shares, dividends on callable preferred shares must be repaid by the issuer ahead of any dividends on its common shares. Convertible preferred stock is preferred stock that includes an option for the holder to convert the preferred shares into a fixed number of common shares, usually any time after a predetermined date. And finally, cumulative stock is a preferred stock whose annual fixed rate dividend, if it cannot be paid in any year, accrues until it can and is paid before common dividends. Bonds are the second major category of securities investments. This is a certificate that is issued by corporations indicating that an investor has lent money to a firm or a government. Bonds are a form of debt financing, as we previously talked about. It's also important to note that unlike dividends, interest payments are tax deductible. The yield or interest on a bond is the interest income a purchaser receives from the bond. Here's an example of how yield works. When a bond is first sold, the issuer offers a specific annual interest rate known as the coupon. A $1,000 bond with an 8% coupon, for example, pays $80 a year in interest. There are some advantages of issuing bonds. Bondholders are creditors, not owners of the firm, and they cannot vote on corporate matters. As I mentioned before, bond interest is also tax deductible, and bonds are also a temporary source of funding that are eventually repaid. Bonds can be repaid before the maturity date if they are callable, just like we talked about the callable preferred stock. Some disadvantages of issuing bonds include that bonds increase debt and can affect the market's perception of the firm. Paying interest on bonds is a legal obligation, and if interest is not paid, bondholders can take legal action. The face value of the bond also must be repaid on the maturity date. Just like stocks, bonds can be callable and convertible. Callable bonds permit bond issuers to pay off the principal before the maturity date, and convertible bonds allow bondholders to convert their bonds into shares of common stock. Finally, one way of relieving the financial strain of retiring many bonds all at once is for the company to set up a sinking fund. When a corporation issues a bond payable by a sinking fund, it must set aside a certain amount of money each year in order to be able to repay the debt. I want you to be familiar with the 5 investment criteria that should be considered for investments. The first is investment risk. This is the chance that the investment will be worth less at some future time than it's worth now. Yield is the expected return on an investment, such as interest or dividends, usually over the period of 1 year. Duration is the length of time your money is committed to an investment. And liquidity is how quickly you can get back your invested funds in cash if you want or need them. And finally, you should consider tax consequences, which are how the investment will affect your tax situation. Diversification helps spread risk by buying different types of investments. In general, when stocks increase in returns, bonds decrease and vice versa. Just as we discussed how organizations may diversify through forming conglomerates to lower risk, investors can do the same. I've provided an example here of how that might look. You might decide to put 25% of your money in U.S. growth stocks, 25% in government bonds, 25% in dividend-paying stocks, 10% in an international mutual fund, and the rest in a savings account. This is just an example. There are many different ways that one can diversify. This slide presents the needs of consumers when it comes to financial planning. Today's brokers provide more than simply the buying and selling of stocks and bonds. Companies like Charles Schwab and Fidelity help individuals plan for the future, as consumers need advice on things such as investing, 401k plans, planning for retirement, as well as the other items listed here. Capital gains are increases in the value of stock over time. Investors often select stocks based on their investment strategy. Stocks issued by higher quality companies such as Coca-Cola and Johnson & Johnson are referred to as blue chip companies, a term derived from when poker, where the highest value chip was the blue chip. These stocks generally pay regular dividends and experience consistent price appreciation. Growth stocks are stocks of corporations in emerging fields such as technology, biotechnology, or internet-related firms whose earnings are expected to grow at a faster rate than other stocks. While riskier, growth stocks may offer the potential for higher returns. Income stocks are stocks of public utilities, which are often income stocks because they usually offer investors a high dividend yield that generally keeps pace with inflation. And finally, penny stocks represent ownership in companies that compete in high-risk industries such as oil explorations. These sell for less than $2, some analysts say less than $5, and are considered risky investments, so the return can sometimes be high. This slide demonstrates something that I talked about with the McDonald's stock on the opening slide. If an organization determines that a stock's price has risen so high that it becomes prohibitive for many investors to purchase, or has simply gotten out of line with similar stocks, the company may announce a stock split. This action divides each share into 2 or more new shares, and the market value is then reduced by the same ratio. Although a stock split does not create more wealth for shareholders, it does give them more shares to take advantage of future price increases. Let's go over stock splits. For an example, if you own one share of stock that is worth $100 and it splits 2 to 1, you now have 2 shares worth $50 each. Stock splits cause no change in firm's ownership and no immediate change in the investment's value. Investors generally approve stock splits. However, because they believe demand for the stock may be greater at 50 than at 100 and that the price may go up in the near future. This occurs when companies see stock price is too high, as I mentioned before, and they split them to make them seem more affordable. An important point to note is that the investment value does not change immediately after the stock split. The investor has the same original dollar value as before the split. As I mentioned before, the hope for the investor is that the lower price will cause the demand for the stock to increase, raising the stock price, which will increase their total investment value since they have more shares due to the stock split. Dividend rates are also divided according to the degree of the split, and most stock splits are 2-for-1 splits. Since 1975, Walmart has split their shares on 8 different occasions. If an individual investor purchased 100 shares in 1980, they would own 25,600 shares after adjusting for the split. I also provided this Investopedia link to provide another example of a stock split. So let's look at Apple. So Apple launched its initial public offering on December 12, 1980. Apple Incorporated is currently the world's second largest company by market capitalization. Apple closed at $200.48 on August 12, 2018, meaning that an initial investment of $220.22 shares would now be worth $112,268, not including dividends. Often in the news, you hear the Dow Jones referred to. This is the oldest index that was originally created in 1896 by Charles Dow and Edward Jones. This is the average cost of 30 selected industrial stocks. The financial industry uses it to give an indication of the direction, meaning up or down, of the stock market over time. It initially included 12 stocks and then was later expanded to include 30. It has changed since it began in other ways too. Companies have been added and removed to reflect the current economy. For example, the book talks about how Disney was added in 1991 to reflect the increased economic importance of the service sector. General Electric, the last of the original 12 companies that remained in the Dow, was removed in June 2018 and replaced by Walgreens. As your book also mentions, some believe that the 30-company Dow is too small and that instead investors should follow the S&P 500. This index tracks the performance of 400 industrial, 40 financial, 40 public utility, and 20 transportation stocks. This slide demonstrates how the stock market has experienced turmoil at different times. October 29, 1929 was the first major crash of the stock market, which lost almost 13% of its value in a single day. The Great Depression followed shortly after this occurred. In October of 1987, the stock market suffered the largest one-day drop up until that time in its history, losing over 22% of its value. And in October 1997, investors again experienced the fluctuation of the market after fears of an economic crisis in Asia occurred. A more recent example, the effect of the coronavirus, COVID-19. The University of Michigan's Index of Consumer Sentiment showed the fourth largest monthly drop during March in the survey's 41-year history, according to data released Friday. And if you look at the what occurred during the stock market in the month of March, it will show you how the market reacts to the news, right? So whatever's going on in the world, the stock market reflects that through people either selling or buying stocks. So what caused the market turmoil of 1987, 1997, and 2008? In 1987, many analysts agreed that it was program trading, in which investors give their computers instructions to sell automatically to avoid potential losses if the price of their stock dips to a certain point. On October 19, 1987, computer sell orders caused many stocks to fall a lot and quickly. The crash prompted the U.S. exchanges to create mechanisms called curbs and circuit breakers to restrict program trading whenever the market moves up or down by a large number of points in a single trading day. A key computer is turned off and program trading is halted. If you watch programming on CNBC or MSNBC, you'll see the phrase curbs in appear on the screen, and this is what they are referring to. So in summary, mechanisms are now used to restrict program trading whenever the market moves up or down by a large number of points in a single trading day, as I mentioned before. A lot of times, these are used to shut down trading for half an hour or 2 hours, or up to 2 hours, so traders have time to assess the situation. We saw this occur during March of 2020 during the COVID-19 coronavirus panic. The markets were halted for a period of time on several different days during the crisis. This concludes Chapter 19. Please let me know if you have any questions.